I always feel like there's some sort of like conventional wisdom that really gets under my nerves. I don't, no matter what it is, like whenever it was 12 months ago, it was cash as a position, right? It was like, well, it's okay to be in a 5% money market fund. And we're like, no, get along here. But I think the one right now that really bothers me, and you hear it in the media a lot, you hear with a lot of like, it's just an assumed type of philosophy. And that's like, well, Donald Trump uses the S&P 500 as his benchmark or a scorecard for how he's doing. So it's impossible for the stock market to go down during his presidency. And man, oh man, you can shoot a lot of holes in that statement.
Well, here's the thing, right? You can tell exactly who they voted for, whoever says that, right? So you have,
It's true.
we have clearly a very polarized political situation in our country. And you have one half of the folks who voted for him who believe that, right? And they're very enthusiastic. They want to be suddenly 100% long, the most risky assets they can get their hands on. And then you have the people who didn't vote for him, and they want to be 100% short and totally out of the market. So they're allowing their political views to impact their investment decision making.
And who said we had an easy job, Court?
It's interesting you say that, Bob, because we actually had a lot of clients before the election who were coming to us, and they were openly telling us their political views and saying, we're really nervous about the election, nervous about who's in. And we were finding that there was people who, were pro-Trump, who are really looking at, I want to get more conservative. I want to take some risk off the table. And suddenly they don't want to make any changes to their portfolio any longer. He got in and they said, nope, you know what? Actually, I want to stay really aggressive. I don't believe in bonds anymore. I don't need cash. Like it's changed completely, which is interesting. And you're getting the opposite side where, you get people who are anti-Trump and they are very nervous what the next shoe to drop is. And especially right now, you're getting a lot of different political headlines. So whether it's like the tariffs this week or, whatever it is, there is always something that's in the news. It's just really instilling fear on the other side of people. So I don't think that's going to end anytime here soon, but I don't think it should get in the middle of your investment strategy either way.
But guys, it's never different, right? It's never different. I mean, every election cycle since I've been alive and aware, people have hair's been on fire, the month or two before the election, right? We actually, we had to do a seminar, not this past election, but remember 4 years ago, guys, we had to do a client fireside chat because we had so many people who were like liquidating their portfolio because in their mind, if Biden won, the market would crash and they'd get the buying opportunity of a lifetime. And if Trump got a second term, it couldn't go up more than just 10%. Like somehow they knew all this, right? And thank goodness we talked them off the ledge and demonstrated through our fireside chat that it doesn't matter who sits in the White House. The market does the same. GDP does the same. The economy does the same. They would have missed a 30-40% move in the prior election had they gotten out of the market. And the same thing happened with this election.
Yeah, I was talking to a client of mine a couple weeks ago, and he pointed out that the portfolio is very overvalued right now. We should probably just go to cash, if not bonds. And we went through everything, every holding in his portfolio, and I asked him to point out what in his portfolio is overvalued. And he could only point to one or two things.
Well, what's good about the election cycle and having different parties at different times is like people start to study history. All of a sudden, we know about President McKinley, who had tariffs, right? I mean, who's heard of President McKinley in their lifetime, right? And then you have the other side who's very negative saying, well, you know what happened during the Depression, right? We had the Smoot-Hawley tariffs that, put us into the deepest depression and the economy tanked, for an entire generation. So it's, it's amazing how the headlines, are dominating how people think. And meanwhile, you shouldn't be thinking about your investments every day. You shouldn't make any changes on a daily basis. I mean, if you look quarterly, that's a lot. You really should be focused on what's really important, which is, achieving your goals.
And that's really what you're investing in at the end of the day, right? You're investing in companies. You're not investing in the U.S. government. I mean, I guess maybe if you have treasuries. But, these companies are going to figure out how to do business regardless of who's in office. So as long as you believe that these companies are going to continue to do well, they're going to continue to grow their earnings, they're going to continue to grow profit, and the economy is going to continue to do well. And you're seeing that, right? Earnings seasons come out, companies are doing strong, and they're really optimistic on how things look in the future, generally speaking. And that's what you're investing in at the end of the day. And I think that's what you really need to focus on of where are you putting your money? It's in these businesses that are, in the U.S. or abroad, wherever that case may be.
You're right, Courtney. It really just goes back to the basics. Like, are people going to stop putting gas in their cars? Are they going to stop brushing their teeth? Are they going to stop eating? Last time I checked, it's impossible to stop eating. I know that's true for Ryan. And there's going to be companies that are can produce these goods and services. So there's
Chris,
good,
what the big problem is? Courtney's on CNBC, and then the next day Ryan's on Fox Business. So, when Courtney's on, these clients call me up and go, so you guys are left-leaning in your political view. And I'm like, no, we're not. We're a financial organization. We don't subscribe to politics. And then the next day, Ryan's on Fox Business. So you guys lean right and are conservative in your views. No, we are apolitical. We're an investment organization, and we're investing in the markets. We're not investing in Washington, D.C. So
we're agnostic and we're soulless. Is the best way to put it. But, I think actually you said something interesting last week, Bob, on the podcast, which, I think, well, it's rare. So you got to point it out when it happens is, the business cycle hasn't been repealed. And, there's nothing on Capitol Hill that's going to stop the business cycle from happening or unfolding the way it's going to unfold. And, I think what people forget is we think there's a lot of great opportunity in the stock market, but the S&P 500 specifically, is up over 70% over the last 2.5 years. It's a little long in the tooth when you start thinking about artificial intelligence, the Magnificent Seven. These stocks aren't cheap. And it doesn't matter who's in office, they can't stop that business cycle from happening, right? If there's going to be some disruption because of like this DeepSeek, which is like the Chat GPT out of China that apparently they can do artificial intelligence cheaper with lower powered chips. Like all this stuff can't be controlled by what's happening in Capitol Hill. These forces are much greater. And I think that's important to keep in mind as you allocate your portfolio.
Well, capitalism's all about creative destruction. And, these disruptors, which you think, wow, I'm going to make a killing investing in companies that are disrupting. Well, they get disrupted. So, you got to be able to predict who's going to disrupt whom and when and where and how. And next thing you know, you're sitting in cash. You can't make a decision.
I think the only thing here that can't be disrupted is Bob's hair. That's been a constant since the 1970s.
Make your portfolio like Bob's hair, right?
Well, a good buddy of mine texted me just before the podcast that the hedge funds are betting heavily and shorting the market globally. They're betting against the market. So I looked up the average return of hedge funds last year, and it was about 2/3 less than the market. So I guess there's a reason why, I think when we had Joe on talking about hedge funds, 9 out of the 10 clients he covered when he started the industry are gone, bankrupt. So, I don't think you want to use hedge funds as your indicator of how to invest.
Well, the other thing to keep in mind is expect the unexpected, right? Who would guess this year with Trump being in office, tariffs, who would guess that Europe is dramatically outperforming almost every other market in the world? Europe's up 8-9% as we're recording this. And ironically, China's up 8-9%. And you would think the exact opposite, given the fact that we're being very contentious right now with our trading partners. That's one of the other variables you have to think about is it's just impossible to know how it's going to play out, right? I mean, one day, Donald Trump's talking about tariffs. He slapped a big tariff on China this past week, and China went up. So, I think that's the other part of it is, and Bob, you talk about this a lot, it's the beauty contest, right? It's not what you think beauty is or I think beauty is. It's what the contestants think beauty is. So you never know how the market's going to react.
That's right. It's the judges, right? It's the judges. You got to be able to read the minds of the judges. You got to know what their perception is. So, even though you might be right about your predictions, but you don't know how it's going to be judged by millions of other people hitting the buy or sell button on their computer.
Also, the question is how long that's going to last. I was actually waking up on Monday morning to all these headlines saying, brace yourself, markets are dropping because tariffs had just been announced on Mexico and Canada. By the end of the day, markets have recovered. We're basically positive by the end of the day. And that's something where, you get these fear instilling headlines. And I had clients emailing me what should we do? Should we make changes? A lot of these things are going to be somewhat fleeting, and they really shouldn't make investment decisions based on whatever the headline is today, because it's probably going to be different tomorrow, and markets have already likely moved on at that point.
Courtney, I'm sorry. I have to apologize to you, but we just implemented a new investment strategy. We're meeting every morning at 8:30 just to try and guess what the Trump administration is going to do that day, and we're going to change your portfolio accordingly.
Well, that's the other thing too, is there can be knee-jerk reactions in here in the short term, and I think the president clearly affects that. But I think if you look at the bigger picture and you're allocating your portfolio for retirement, it's a fool's earn to sit here and try to figure out how to allocate your portfolio based on whatever our president likes to say on a whim on any given day. And again, just expect the unexpected, right? You don't know what the winners are going to be. You don't know who the losers are going to be. We can speculate, but the only way to really protect yourself is to own everything, properly diversify, because conventional wisdom and whatever seems like the obvious way things are going to go typically doesn't go that way.
I think what it is, guys, you're saying don't let your political views or feelings interfere with your investment decisions, because you can't control that. You can't control who got elected. You can't control what decisions they make. And it's like the market. You don't want to wait around to invest in the market you want, right? You invest in the market you have. We've been doing that for a good 50 years, and it's worked out really well.
Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review.
All right, it's a tipping point. This is where we pinpoint the pain point. Of course, that's Payne, having the biggest impact on your wealth right now. And guys, I'm getting a lot of this lately, is the S&P 500 has done so well over the last 15 years or so. There's a kind of a conventional wisdom out there, like, why would I own anything else? And when I'm looking at my return, shouldn't I be benchmarking it to the S&P 500? And if I'm not doing as well as the S&P 500, it's time to make changes in my portfolio right now.
Well, I think that's the concept of you got to look at your total wealth, right? And I have a really good friend of mine who's an accountant, got lucky and bought NVIDIA, and that's all he talks about when they do their taxes every year. Why don't you have all your money in NVIDIA? And I'm thinking, well, let's go back and ask him, does he have every dollar, every bit of his wealth in one stock? I mean, how foolish can that be, right? I mean, so I think when you look at any investment, no matter how well it does, the question I think top of mind is every dollar.
This is the thing too, where when you are looking at the S&P 500, more than a third of that index with 500 stocks is just 7 companies that take up the biggest weighting there. And then you look at some of the other major indices like the Dow. So that's what the news always talks about, is the S&P 500 and the Dow. The Dow is also a majority of just those big tech companies. So it's really hard to avoid them right now. And they've done really well over the last year or so here, especially with artificial intelligence. But the question is that getting a little long in the tooth? Are those things expensive? Is that the next thing that's going to take off? And do you want to be overexposed in it? We would say no. We think there's a lot of other areas of opportunity. You shouldn't be overly concentrated in just those few things that have already had such a big run up.
Well, I think it's more problematic than that. Because it's kind of like, well, first off, I would call that a trader mentality, right? If we're trying to guess what's the next best place to be tomorrow or next week, or, we try to outperform and benchmark, that's trading. But you have to think about, if I'm building a portfolio to live off of, should I be using a trader's mentality? And we know statistically over time, traders lose money. Statistically, 80-90% of traders fail. And I think what it comes down to is we got to remember the S&P 500's had a great 10, 15 years, but the prior 12 years, you made no money owning the S&P 500. Now, that's fine if you can say I can wait it out. But if you're close to retirement, you're retired now, you're living off your portfolio, you can't afford for your stock portfolio to return zero over a decade. That's a recipe for disaster.
And I think sometimes to people it seems so easy, but you think about like the Magnificent Seven, that's 7 stocks, right? You have to be right by picking 7 stocks. And if you think about it, there's probably somewhere in the magnitude of 10,000 publicly traded companies, and you're going to be good enough, smart enough, do enough research to pick that 7. I mean, those odds don't sound that good.
Yeah, but it's just like everybody's now an historian because about President McKinley and his tariffs and Herbert Hoover and his tariffs. All you have to do is study the history of the markets, right? Whenever you have a narrow market, and I don't know if everybody knows this or not, but last year was the most narrow market in terms of, a few stocks carrying the index. It was the most narrow market since 1999. And you know what happened after that? It's like Ryan said, you had the death of equities for 10 years. You had a no return index where you made zero, for 10 years. Now, we also had that happen in the 70s with what was called the Nifty 50. And believe it or not, people were paying 200 times earnings for these hot stocks like Polaroid and Simplicity Patterns. Court, when's the last time you and your family made their own clothes? I mean, that was a hot stock, believe it or not, in the 70s, Simplicity Patterns. You might be in the Simplicity Patterns of 2025. I don't think it's going to end well.
That was the hot technology. I love that, Bob. That is a throwback.
No, but I think also we have to think about your retirement. Chris, you've said this before. I think this is a great point. Look, you're building a Volvo. You're not building a Ferrari, right? The Volvo, no matter what happens, you're going to be protected, right? If you go off the rails, there's going to be some cushion in place. There's going to be something to protect you. The problem is with the Ferrari, right? When it goes out of control, you're banging into a tree and everything gets destroyed. And I think that's the big risk here. But it doesn't feel like a risk when everything's going up. But the problem is markets do go down. As Bob likes to say, the business cycle hasn't been repealed. The market cycle hasn't been repealed. When that happens, you have to ask yourself, am I protected?
Well, you know what they said about the Volvo, don't you? It's boxy, but it's good.
As a Volvo owner myself, it is very safe for my family, and I highly recommend. I also am a diversified investor, so I think that goes with our theme.
So it's like Payne Capital Management portfolios. They're boxy, but good. I like that.
Well, here's the thing. You don't get last year's performance by buying the investment that's already up. I mean, it's such a terrible mentality. I got schooled on how good an investment NVIDIA is by my beverage manager at my club the other night. And I said, do you know the stock hasn't gone anywhere in 6 months? Matter of fact, it's down 15% year to date. Why is that a good investment? It's people, they invest in things that are already up. You make money investing in things that are about to go up.
The problem with that is, and I get this, is when a stock's going up for so many years in a row, you're just like, why can this be bad? But the problem is you only need one bad year, and that can ruin your entire return, right? And people forget the S&P 500 can draw down 50, 60% in any given year. It did that from 2000 to 2002. It did it again in 2008. We had a modest 30% decline not that long ago. You just need one event, and it can ruin everything. That's the problem with investing. So you need to do everything you can to possibly avoid that one event that happens from time to time, and no one's going to tell you when it happens. Hence, that's why you diversify.
Well, guys, 6 years ago, 7 years ago, our client said, hey, I'm wealthy. I'm parking this money with you. I want you to preserve it. I don't want to make a lot of money. I just don't want to lose it. Now there's some people are saying, well, hey, I want to make, hey, while the sun shines, I want to get the most out of this bull market, get me long as you can. But you have to remember, equity risk is there because the returns, in order to get those returns, you got to be able to handle a 50% decline, right? No wonder stocks do better than bonds over time. They don't do better every year, but you got to be able to handle the 50, 60% decline. And I don't know anybody that can handle that.
Well, handling it is one thing too, but I think your time frame is another, right? Like we have a lot of clients who are already drawing on their portfolios and wanting to get 100% of the markets. And that's what you need to look at and say, okay, if there's a 50% drawdown, you can't say, oh, I'm just going to wait for it to recover. When you're taking money from that every year, it's going to make it that much harder to recover. So If you're in your early 20s, you want to be 100% of the markets, it's a completely different conversation than my early 60s clients who are actually constantly telling me that right now, who are optimistic, saying, let's get all in. You just really need to look at your own situation, see how much risk do I actually need and am I willing to take?
And yet add to that, when the market does go down, everyone's going to be screaming apocalypse now, like it's the end. So not only is it like we're down, but there's no one reassuring you like, hey, things are going to get better. If anything, the media is going to tell you it's the end of the world. So you have that, couple that with the fact that, look, if you've created wealth now, I'm not talking about some dude in his basement trading $10,000 worth of Bitcoin, which maybe you had a 50-60% drawdown. It's a little bit different than having a multi-million-dollar portfolio you're going to live off of. The stakes are much higher. And with the market up as high as it is right now, specifically the S&P 500, you've got to be even more diligent, more hands-on risk management than ever.
You know, Ryan, it reminds me of that salesman's mentality, right? Everybody knows somebody in some form of sales where they build their lifestyle based on their best year ever. And then they're shocked. Like, oh my goodness, suddenly mortgage rates went up and I only sold a third of the homes that I sold over the last 5 years. So, you want to accept that same mentality. Don't let yourself fall into that trap, because as I always say, trees don't grow to the sky. Portfolios don't go up every single year.
All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, the wealth effect is real. From the third quarter of 2023 to the third quarter of 2024, household assets rose 17.9 trillion, with 10 trillion coming from directly held equities and another 2.6 trillion coming from real estate. Man, oh man, Americans are becoming a lot richer.
Well, Ryan, of course it's up huge. I mean, we started the firm in 2008. We told the entire universe, if you're not long, you're wrong. And thank goodness, all our clients got long, and they're benefiting from part of that 17 trillion.
Yeah, I mean, the other component to that is when people's house values go up, they see their stock portfolios going up, makes them more inclined to spend money. And as we know, U.S. economy is driven by the fact that people in America love to spend money. So that's definitely a good omen for economic growth this year.
Well, I think the big wild card was, all the baby boomers, 10,000 baby boomers retiring a day. Everybody thought, I'm telling you, 20, 30 years ago, the conventional wisdom was, hey, when these boomers start retiring, you better be out of the stock and bond market because they're going to liquidate all their investments because they're going to need to live on. Well, what they didn't bank on is the boomers going out there and acting like teenagers and not, just sitting back in retirement. They're spending money, they're traveling, they're gifting money, they're out to restaurants every year. They're overwhelming the healthcare industry with appointments. Matter of fact, I got to go, guys. I got a doctor's appointment.
One would argue, Bob, you act like a teenager your whole life, but that's for another podcast.
Welcome to the baby boom generation.
I heard gifting in there. I haven't seen any gifting.
Yeah, I'd like to hear more about gifting, Bob. That's
talk to your sister. She has grandchildren.
All right, Chris. GigaChad, apparently a meme coin representing tokenized masculinity. A webpage explains that there is no intrinsic value or expectation of financial return. However, it's up 9,100,000%. I'm saying that right. Over the past year with a market value of more than 600 million. Apparently on the website, there's a picture of a dude with a beard and phrases like, I don't care, I win.
I think this is like the financial version of like flexing in the mirror. Like, you know what I'm talking about? Who needs intrinsic value when you've got like, meme stocks and biceps?
Chris, I want to talk to you about your masculinity. I think you need to work on it this year.
I have a lot of Chad coin instead, so maybe I'm compensating.
We can feel the testosterone coming through. Actually, the screen, it's working.
But it's funny. Like Bitcoin is like, it's got like this bro stigma to it. I don't know if you remember, right, but in 2021, you and I went to a conference in Miami, and I think of the 4 conferences that were at the hotel, 3 of those conferences were Bitcoin conferences, and it was all dudes.
It wasn't far from the top of that, I guess, Bitcoin peak back in the day. So, and I think I even said some bad things about Bitcoin on stage, and the crypto pros didn't like it. So, story of my life.
Bitcoin bros, I love that.
All right, Court. The average probability that a recession will occur within the next 12 months, according to 70 or so economists polled by the Wall Street Journal's Economic Forecasting Survey, has been declining for the past 10 quarters, from a 63% chance in the third quarter of 2022 to just 22% today. The contrarian in me is actually concerned that more economists don't think we're going to a recession anymore. That was like a good sign we weren't going to go into one before.
Yeah, that's exactly right. And I think this is why you don't want to time the markets. You don't want to listen to the experts who are out there who are calling for a recession, because you can see how a majority of them were calling for a recession that never happened. We actually saw this with a lot of clients. They were holding cash. They didn't want to get all in. They said, no, things are bad. We don't want to be invested. You missed a lot of upside return over the last couple of years here. So it's just better have a strategy, stay invested for the long run. Don't listen to the doomsdayers out there. They're going to be loud. They are not always right.
It's like the old adage, the analysts have predicted accurately 50 of the last 3 recessions.
Well, it's amazing too. I mean, the market's up like 70%, right? Just over a little over the last 2 years. There's a big premium to wait for certainty when it comes to investing in the markets. Hey, hope you enjoyed episode 191, Payne Points of Wealth. If you like our podcast, you love our podcast, please give us that 5-star rating on iTunes. You can give us a 5-star rating on Spotify. You can subscribe to our channel. If this is on YouTube right now, you can like this episode. You can subscribe to our channel as well and click that notification bell to be updated every week of all our new content. Your support gives us the support to continue to do this podcast. Spread the good word. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at BeBullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.